15.84. That is the exact number telling us just how fast global market fear can literally vanish overnight. Looking at the VIX, the fear index, plunging all the way down to 15.84 today, we can see exactly how dramatically the recent market panic just completely subsided. Hello everyone, welcome back to AI Market News. Today is July 10th, 2026, and we're tracking a market where easing Middle East tensions plus a really relentless semiconductor rally totally defined the entire trading session. Section 1. Global Catalyst in Oil. To understand today's action, we really have to start with a global catalyst. The U.S. Central Command announced the completion of its strikes on Iran. As you can see in the chart, with that imminent threat to shipping removed, crude oil futures pulled back pretty sharply, falling about 2% to settle right around the low $72 range. Based on available data, ceasefire hopes have definitely reemerged. But, why does this specific drop in oil matter so much to the broader financial ecosystem? Well, let's break down the underlying mechanism here. When a geopolitical flashpoint like this shows signs of cooling off, it removes a massive risk premium on oil. Lower oil prices mechanically lead to lower near-term inflation expectations, simply because energy costs factor into literally almost everything we buy. And when inflation expectations cool down, it naturally drags down Treasury yields. It's basically a predictable domino effect. Lower risk equals cheaper oil, which means less inflation panic, ultimately making borrowing costs cheaper across the board for all of us. Section 2. Yields and Wall Street. So that domino effect takes us straight into the bond market. The graph shows the 10-year Treasury yield easing down to 4.533%. Now, this easing of borrowing costs is exactly what equity markets want to see. When bond yields drop, the future cash flows of growth-oriented companies actually become way more valuable in the eyes of investors, creating a really supportive environment for stocks to just rally aggressively. Section 3. The semiconductor surge. That combination of falling oil and falling yields, it provided the exact macroeconomic relief U.S. equities needed. By comparing these two charts, we can clearly see the divergence in momentum. The Dow Jones industrial average rose for the first time in 3 sessions, posting a nice steady gain of roughly 139 points. But the tech-heavy NASDAQ composite, it was the undisputed star today, surging a massive 336 points. So while the broader market rallied on that economic relief, tech just simply exploded higher. According to current market information, this surge was driven by very specific catalysts in the memory chip sector. For instance, Micron Technology announced plans to invest up to $3 billion in its U.S. supply chain, directly pointing to the surging demand for AI memory chips. Concurrently, we saw reports of extremely strong demand for SK Hynix's upcoming U.S. listing. The underlying mechanism here is super straightforward. Modern AI requires massive amounts of advanced memory processing power, and investors are aggressively positioning themselves for this exact infrastructure build-out. This huge appetite pushed the broader Philadelphia Semiconductor Index up by an impressive 3.1%. Section 4. Tokyo markets react. That blistering tech momentum carried right across the Pacific into the Tokyo session during JST trading hours. The graph shows the Nikkei 225 extending its own rally, closing up nearly 814 points. AI and semiconductor names absolutely led this advance, perfectly tracking Wall Street's tech strength. Now, we should note that some of these gains were trimmed slightly later in the session due to ETF-related redemption selling. This is a structural mechanic where funds automatically sell underlying stocks to pay out investors. But even despite that mild headwind, the overall sentiment remained incredibly robust. Section 5. Yen shifts on policy. While equities rode the wave of global relief, the most fascinating dynamic for all of us today actually unfolded in the currency markets, triggered by a major shift in domestic policy signaling out of Japan. As you can see in the chart, the USD/JPY pair experienced a dramatic overnight drop, falling pretty sharply from around 162.40 down to roughly 161.28. This sudden, aggressive strengthening of the yen immediately caught the attention of institutional traders everywhere. The why behind this sudden yen strength is absolutely critical for all of us to grasp. Reports surfaced that Japan's upcoming big bone policy framework will explicitly affirm BOJ independence. Markets have been quietly worried that the government might pressure the central bank to keep rates artificially low, which would have widened the yield gap with the US and punished the yen even further. By formally confirming the central bank's independence, this political risk is essentially removed, allowing the BOJ to normalize interest rates at their own pace. This reduction in political interference is mechanically yen supportive. Plus, this news was paired with the finance minister's push to encourage the GPIF, Japan's massive government pension fund, to increase domestic investments, which adds even more structural backing to the currency.
Section 6, Economic Calendar Ahead.
Looking ahead to next week, we have a genuinely loaded economic calendar to keep an eye on. On Tuesday, July 14th Eastern Time, we're going to get the crucial June CPI report, right alongside major Q2 earnings from banking giants like Bank of America, JP Morgan, and Goldman Sachs. But most importantly, newly appointed Fed Chair Kevin Warsh will deliver his first semi-annual testimony to Congress on July 14th and 15th. This is a vital moment for all of us trying to gauge how the new leadership actually views current inflation data and future rate policy. With geopolitical tensions easing, but the Fed's next moves kind of uncertain, the big question we have to ask ourselves is, are we looking at a sustained summer tech rally? Or is the market maybe pricing in a bit too much perfection? Thanks for watching. Please subscribe and hit the like button. This video was automatically generated by NotebookLM AI. AI-generated content may include errors. This video does not constitute investment advice. For full details, please check the description below.